So, how do you actually know if a country's economy is doing well? Is it growing? Is it healthy? Well, there's a tool for that, a really important one. It's called national income. And honestly, the best way to think about it is like a country's annual report card. It tells us how they did that year.
So here's what we're going to cover. First, we'll get into what national income really is. Think of it as a country's paycheck. Then we'll look at the simple loop of how money moves around. After that, we'll dive into the 3 different ways to measure it, counting what's made, what's earned, and what's spent. And finally, we'll talk about why this simple idea gets, well, pretty complicated in the real world. All right, let's start with the basics. When you hear economists or news reports talking about national income, what are they actually talking about? What are they measuring? Now, this quote is from way back in 1949, but it absolutely nails it. Let me translate that into plain English. National income is just the total money value of all the final goods and services a country produces over a year. And that last part, counted without duplication, is the most important rule of the game. We'll see why in just a way. Okay, so to measure the whole economy, we first need a basic map of how it works. And when you strip it all down, an economy is really just a simple, continuous loop where money and stuff are always flowing.
So, if you had to boil a whole, complex economy down to just 2 main players, who would they be? Who's at the heart of literally every transaction?
It's just households and firms. That's it. It's us, the people, who provide our labor and buy things. And it's the companies, the firms, that hire us and make the things we buy. We supply the ingredients for production, and they use those ingredients to create everything else. And this is what it looks like. It's called the circular flow. See, households provide things like labor to firms. In exchange, firms pay us an income, our salaries. Then what do? We take that income and spend it on the goods and services that the firms made. It just goes round and round. Your spending becomes a company's revenue, which then becomes someone else's income. It's all connected. All right, now that we see this flow, how in the world do we measure its size? Well, the first and maybe most obvious way is to just add up the value of everything a country produces. This is called the output method. But right away, you run into a huge problem. It's a trap called double counting. If you're not careful, you'll end up counting the value of, say, raw cotton, and then counting it again when it becomes thread, and again when it becomes cloth. Your final number would be massively inflated. To get around this, economists use a really clever idea called value added. It's simple, really. At every single step of making something, you only count the new value that was just created at that stage. You completely ignore the cost of the materials that came from the previous step. This table showing the journey of a shirt makes it super clear. Look at the value added column. The cotton farmer adds 150 rupees of value. The yarn mill adds another 100. The cloth factory adds 150, and the shirt maker adds the final 100. Now add up just that column, and you get 500 rupees, which is, surprise, the final price of the shirt. It's a perfect way to measure the total value created without counting anything twice. Okay, so that's one way to look at it. But what if instead of tracking what's made, we track what's earned? Remember that circular flow? This brings us to method number 2, the income method. With this method, you just add up all the income that gets paid out. So you're counting all the rent paid for land, all the wages paid to workers, all the interest paid on capital, and all the profits earned by businesses. What's so cool about this method is that it doesn't just give you a big number. It actually shows you how the economic pie is being sliced up. Who's earning what? So we can measure what's produced, and we can measure what's earned. What's the third side of this triangle? Well, it's measuring what gets spent. Because logically, all the income that's earned from making things has to be spent somehow. And that's the expenditure method. This approach breaks down all spending into 4 big categories. There's consumption, which is all the stuff you and I buy. There's investment, which is what businesses spend on things like new factories. Then there's government spending. And finally, net exports, which is just what we sell to other countries minus what we buy from them. This view is so important because it tells us who's driving the economy. And here's the big aha moment. Production, income, and expenditure. They're not 3 different things. They are 3 different windows, all looking at the very same economic flow. The value of everything we make has to equal the income earned for making it, which has to equal the total amount spent buying it. In a perfect, theoretical world, all 3 methods give you the exact same number. Of course, we don't live in a perfect, theoretical world. In theory, it's all neat and tidy, but in the real world, it gets messy. Actually, trying to calculate this number is incredibly difficult. I mean, just think about it for a second. What about all the valuable work done at home by a parent? No money changes hands, so does it count? And what about when you sell your old car? That car's value was counted when it was first built. Do we count it again? These are the kinds of tricky questions that make this whole thing so hard. So to avoid total chaos, statisticians have a bunch of strict rules. When they use the income method, for example, they ignore government payments like pensions. Why? Because that money isn't from creating a new good or service, it's just a transfer of money. Same goes for selling a used car or some stocks. That value already exists in the economy. And in a point that's pretty controversial, they have to ignore all unpaid services, like all the work done within a home. And the big rule for the expenditure method is basically the same idea. You only, and I mean only, count the money spent on the final product. So we count the 500 rupees for the finished shirt, but we do not count the 400 the shirt maker spent on the cloth. If we did, we'd be right back at that double counting problem. And on top of all these rules, there are just massive practical headaches. Can you imagine trying to figure out the exact value of every unsold product sitting in every warehouse in the country? Or trying to track all the cash-only jobs in the informal economy? It's a huge, huge task. So after all that, after hearing how hard and messy it is, you've got to be wondering, why bother? Why do governments and economists put so much effort into getting this one number right? Well, because pretty much all major economic policy is built on this number. It tells the government if their employment policies are working. It helps us build models to predict future growth. It acts as a kind of national accounting system. It's the ultimate yardstick that lets us compare our economic health from one year to the next. It's not just a number, it's a vital sign for the entire country. But this leaves us with one last and really critical thought. National income is fantastic at measuring the value of what we produce and sell, but it's completely silent about things that don't have a price tag. Things like the cost to our environment. So as we continue to measure our success by this number, it's really worth asking, what important costs are we leaving out of the final tally?